Kelly Connolly from JHS Capital Advisors. Mark Matson is here from Matson Money. Mike McQueen from Hightower. Sam Stovall from S&P Capital IQ. And our very own Rick Santelli. Welcome, one and all. Sam, first of all, this IBM's earnings miss does take down the earnings trajectory for the whole tech sector at this point, doesn't it?
It sure does. It was tech sector was expected to be up more than 4%. Now the tech sector is up in the 3 to 4% zone. Also brought down the overall S&P 500 estimate to below 5% right now. But our expectation is we'll probably peak back above that 5% level.
I think that the economic indicators we're seeing are not indicative of any kind of a recession. We've got strong data coming in. We've got earnings that are encouraging. The housing starts came in very positive last Friday, which suggests forward growth. The manufacturing sector is a little slow, but still it's in the expansive territory.
So I continue to think that the message of the fixed income market is not really being taken to heart by many, and I think it's an important message. Now, tonight, the message is that growth is substandard around the globe, and even though the U.S. is definitely the stellar player with regard to growth, it's still a bit substandard. Productivity is definitely under historic norms for a post-recession type economy, and I think we're very vulnerable from a number of huge issues.
Which one is it that the market's ignoring? Is it the fundamental weakness that Rick's talking about? Is it the fundamental strength that Lee Cooperman was saying?
Well, you know, it's hard to go against Leon Cooperman's advice, but the market's clearly focused on the 3 E's, you know, Ebola and Europe and earnings right now. But I think in a couple of weeks what you're going to see happen is that there's going to be a change in tone. We're going to remember that the consumer, who's 70% of our economy, has 3 big tailwinds, which is improving employment, low energy prices, and low interest rates. And we're going to start to talk in a couple of weeks about a holiday shopping season, and people are going to realize that there are tailwinds behind the consumer.
What is your take? I mean, how likely would you put the odds of a U.S. recession here? And what about Europe and the extent to which they're, if you will, exporting their weakness around the world?
Here's the problem. If you look at recessions over the last 80 years, the market actually does better by about 1% per year when you're in a recession versus just a growth period.
Wait,
so it's really counterintuitive.
It's
Mark, really counterintuitive.
Wait a minute. Wait, you're not seriously telling me right now. You're not telling our audience that if we were in recession,
equities historically have performed 1% better than in a growth economy. It's very counterintuitive. But here's the main message.
In a recession?
Stop
do you
trying
mean during?
to
what do you mean by in a recession?
Negative GDP. A recession is any time you have a year, 12 months where you have negative GDP.
So
you're coming to the point.
Here's
the main point.
But it's probably because they've already priced in a 40% drop from whatever the high was. So of course you might get some sort of snap off the lows.
Here's the point. Stop trying to predict the market. Nobody can predict the next 5 or 10% movement. Trying to predict the market in the short term is nothing but a guess, and you should never manage your money based on a guess about the future. You need to hold equities over a 10 to 20-year period. Stop thinking about 6 months, and then when markets go down over the last month, you need to rebalance and buy equities. Look, U.S. large growth stocks are up 215% since the last recession, since the crash, but no one's talking about that. Most people miss the 200% because they're trying to predict it in the short run. Own it long term, diversify internationally. Japanese stocks are up just 4% today. You need to be in 12,000 stocks in 45 different countries. And if you are concerned about risk, you need to offset that with short-term fixed income and rebalance.
I understand what you're saying. Again, a 10 to 20-year time horizon, you know, these wiggles, if you will, don't matter quite so much. But for people who are trying to make decisions about, you know, how much money they might have at the end of the year or next year, certainly an event like a bear market would be a big deal.
If you can't stand that volatility, you need to be in cash, period, no matter what you think the market's going to do.
You know, you're picking from the worst possible March of 2009 to get your 200+%. Look at a 10-year horizon if you want to be long-term, and it definitely is much smaller than that 200+%.
Equities have done great over the last 10 years. If you owned emerging markets,
but not as good as picking the bottom and then nailing it. We all know that in 2009 the market overcompensated to the downside. So, you know, we need to be open about the notion that there has been a lot more lateral moves to the fixed income, or excuse me, the stock market than just by looking at what happened post-crisis.
Yeah, that's for sure. Guys, we have to leave it right there. Actually, we've got some breaking news.